All right, what does any of this mean? Are you piecing any of this together? Well, Gloom, Boom, and Doom report publisher and sort of someone the markets follow very, very closely, Marc Faber says, not necessarily these items, but a recession is in the offing. Mark, it's good to have you. Joins us on the phone. What are you seeing?
Well, thank you for having me. What I'm seeing is a global economy that is slowing down massively, with some countries already in a severe recession. And we have to agree on how do we measure global GDP. If we measure global GDP in US dollars, then countries like Australia, Canada, the Eurozone, Japan, which have all had a declining currency, are depressing global GDP, and as a result of that, by definition, the world is actually in recession already. In the US, we have also in industrial production already a recession, and in my view, it will spill over into the service sector.
Now, we've had a bumpy start to the year. China gets a lot of the blame, for that, Mark. And I'm wondering whether we just throw it on the Chinese. It was just a slight downtick in their manufacturing sector. What do you think?
I like bumpy starts. We had a big downdraft on the first day of trading. On an annualized basis, it would be horrible. But anyway, the market has become a little bit oversold and may rebound, but I wouldn't bet on it. I think what has happened since the 80s, we had massive asset inflation in bonds, stocks, since 99 in commodities, and this is now over.
So what happens now?
Well, as you know, so many hedge funds have closed down or are closing down because they can't make any money. And these are the smart people. I'm not as smart as they are, but if they can't make any money, typical investors will not make much money in the years to come. In my view, it will become a stock pickers market, and you will have to be very selective in individual markets. So, for instance, I could say Russia is cheap, and the US market is very expensive. I could say Vietnam is relatively inexpensive and the US is expensive and so forth. But in general, if the US goes down, it's likely that the other markets won't go up substantially.
So if you are one, and a lot of people either through their 401ks or pension plans that are automatic investors and they're buying, indexes that mirror the performance of the S&P, the Dow, NASDAQ, a foolhardy venture this year, or how would you describe it?
I wouldn't buy any index right now.
Really?
I would certainly not in the U.S.
What about gold? What about gold and some of the ones that are percolating?
Well, I think this is the only sector that has significant, and by significant I mean an upside potential for gold shares of 3 to 10 times, and the downside risk is 100%. You understand?
Right.
So the upside vastly outweighs the downside, whereas on the S&P 500, the downside outweighs the upside.
Mark, the 8th year of a presidential term, a two-term president, is, at least with recent examples, proven problematic. We all know what happened during George Bush's 8th year, in the fall of that year, in the meltdown. We all know the recession started in the implosion of the internet with Bill Clinton's 8th year. Do you see things like that going on? Obviously, George Bush's 8th year, much worse, but that things just unravel, and politically, who does that damage?
Well, it's interesting that you mentioned this, because under the indices, the typical stock is already down substantially.
That's right.
I mean, there are very few stocks that have held up the index. So the S&P is down 5%, but the average stock or the median stock on the New York Stock Exchange is down something like 20% already. And there are lots of stocks that are down 40% from the highs. Even Apple is down 20% from the high. So my sense is that once these so-called FANG stocks, Facebook, Amazon, Netflix, Google crater, that the market has actually more downside risk than people perceive.
You're talking about those issues, those big names you mentioned, the Amazons, the Netscapes, the Google or Alphabet, whatever they call themselves, that they crater. They could crater here.
Yes, I mean, they are essentially prized for perfection. And I remember in 1973, in January, we had the Nifty 50 stocks.
Right.
These were stocks like Avon, Xerox, and Boros, and so forth. And nothing could go wrong with these companies. Polaroid, Kodak, nothing could ever go wrong. I worked at that time at White Weld, and people said, for these good companies, no price is too high. And then they cratered by 80%.
Wow. Well, Mark, aren't you a
Kodak
font?
and Polaroid went bankrupt.
All right, aren't you a font of good news? Good catching up with you, my friend. Thank you very, very much. Marc Faber, very influential market watcher and a prescient one. Hasn't gotten everything right, but he's got a lot of things right, a lot of trends right in the past. So you heard his words here. Some of these big names that have had these big run-ups, they could crater. His opinion, his view. But as you know, in this show, we like to hear from bulls, we like to hear from bears, and I always tell my producers when we're done, if we balanced it out, have you heard both sides?